U.S. inflation for the month of March came in about half an hour ago. It showed that a drop in energy prices led the CPI baskets down. The food index, in contrast, rose by 0.4%. In broad strokes, U.S. headline inflation and U.S. core inflation both declined significantly from February and came in more modestly, at a more modest pace of growth than expected by economists. For more, we're joined by Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Gennadiy, thanks a lot for joining us. What's your headline take on those inflation numbers?
Well, it's a very noisy number, Paul, and thanks for having me on. Certainly, you had some components that we were expecting. You had some others, including airfares and hotels, that were a little bit more discouraging. I think they were a little bit of indicative of potentially the kind of a sapping of demand, which I do think we're going to have to keep a very close eye on as time goes on. A lot of the trade policies that have been implemented recently are meant to be stagflationary. I think we're seeing some of the stag, but I think we may also be seeing some of the some of the deflation, certainly, but we're also seeing some of the stag now as well, as we're seeing potentially some declines in demand for hotels and airfares.
Is there anything here that makes the position of the Fed a little easier, as it, like the Bank of Canada, stares at the potential of declining economic growth and stubborn inflation? We did see in March inflation retreat.
Yeah, I mean, it does make a little bit easier the Fed's job. The market priced in some more rate cuts this year. We went from about 83 basis points to about 90 basis points after the report. So a little bit easier in terms of, the moderation in inflation helps the case for lower rates. The issue here is that this is sort of the calm before the storm. We're going to have a lot of upheaval on the inflation data over the next couple of months. I don't think the Fed is keen to move too quickly. We still think they'll actually start to cut rates in June rather than May. So they certainly want to take their time. They want to make sure they're not rushing into anything, and that inflation isn't at risk of taking off unsustainably.
But a cut in June would be much sooner than the market was expecting not so long ago, correct? The market not so long ago was looking way to the end of 2025 for rate cut number one.
Yeah, I mean, if you look at just a couple of months ago, the market was pricing in just about 25 basis points of cuts this entire year. That number surged to 125 basis points just about a week ago, and is now settling at about 90 basis points. So that pricing for rate cuts has been absolutely wild, and we've seen that move around. I do think the Fed is still taking this very, very cautiously. They don't want to overreact. But at the end of the day, if they see that growth is starting to really soften up, and I do think they're keeping a very close eye on that, we still think they'll prioritize growth as long as it looks like inflation expectations are still relatively contained, which is what they look like now.
On a growth-related theme, you have noted in some commentary on these numbers, which are just about half an hour old now, is that there was a decline in airfares and hotel prices, which you say could be an indication of sluggish consumer demand and falling consumer sentiment. Why don't you expand on that theme?
Yeah, absolutely. I mean, we've seen consumer sentiment really down in the dumps on some of this trade uncertainty, on the decline in equities. It's really the high income consumer we're keeping a very close eye on. What we want to make sure is that this hit to wealth that we've seen powering the U.S. expansion over the last couple of years isn't really impacted. It does seem like consumer sentiment is down across all income categories, so that could be creating less demand for air travel, for hotels, as consumers really snap their pocketbooks shut. That's really the theme that we're watching very, very closely underneath this inflationary print, and I think the data today makes it a little bit trickier.
You referred to volatile data ahead as we get into numbers that will report April inflation and growth numbers, May numbers, June numbers, and so on. How volatile could those numbers be? And what about the 90-day pause, the 90-day tariff pause that's been announced? How does that affect your outlook?
Absolutely. What we've seen is consumers already start to pull forward some of their purchases. So it is a rather interesting thing. Consumers have been pulling forward some of the things they use every day, but it looks like, at least from the CPI data, that maybe they forewent some travel and leisure in the process. So a bit of a clamping down on some of the luxury, so to speak. But really going for some of the necessities over the next, call it 6 to 12 months, really is the time frame for this. We do expect consumers to be a little bit more retrenched. We are looking for growth to start to slow down. The issue is one of timing. Right. We have these consistent delays in terms of trade. It's unclear exactly when some of this trade policy will take effect, whether it will, and what the extent of it will be. That is all weighing on consumer sentiment. If that really starts to feed through into hard data, we could see growth really slow down as we get into Q2 and Q3, which is really our expectation. And that should start to really pressure the market and the Fed. And that's why we expect rate cuts starting in June.
And you think by June, the Fed will be in a position to cut its benchmark rate by 25 basis points without reigniting inflation growth?
I think they're going to be very nervous about inflation. That's certainly the pushback we get all the time. It really is dependent on where the inflation's coming from, right? There's really no way for them to contain an exogenous shock, such as the trade policy that's been implemented. What we're seeing is, if they feel as though this is a one-time price level shock, and goodness help us, they've trotted out the word transitory again. But if they feel as though that inflation expectations are contained, they could start to lower rates, but carefully. We are only expecting a 25 basis point cut. We're looking for a 25 basis point cut at every meeting starting in June. So it's a very gradual downward adjustment in rates, not any sort of panic type cutting.
That was Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Thank you so much, Gennadiy. Coming up.